You know that feeling, right? That little knot in your stomach when the stock market starts tumbling. It really feels like your money is just, well, shrinking away. But what if those dips, those moments of panic for many, are actually opportunities? Today, we're diving into how investing greats like Benjamin Graham and John C. Bogle looked at these downturns. We're
Okay.
asking, when stocks go on sale, should you really be buying?
Mhm. It's a fantastic question. And, what's really striking is how these giants, from works like Graham's The Intelligent Investor and Bogle's Common Sense on Mutual Funds, they consistently framed these dips, not as disasters,
Mm,
but almost as predictable chances for people who get the psychology behind it all. It's not just numbers.
right, the psychology. Let's dig into Graham's idea first. He
Mhm.
had this analogy, the market as a pendulum.
Exactly. He saw it swinging constantly, back and forth between irrational optimism, where stocks get way too pricey.
Way overvalued.
Yeah, and then swinging the other way to unjustified pessimism, where they become, super cheap, often way below what the actual business is worth.
Okay, so if the market's this emotional pendulum, how does an investor actually use that? How do you avoid getting caught in the swing, especially when everyone else is panicking or getting euphoric?
Well, Graham's view was the intelligent investor acts like a realist, a clear-eyed realist.
Hmm.
You basically sell to the optimist when things are bubbly and buy from the pessimist when stocks are, like you said, on sale.
So discipline is key.
Absolutely. His core advice, take emotion out of it. Like, never buy just because a stock shot up, and definitely don't sell just because it crashed. It's about protecting yourself from paying too much, fundamentally, not trying to guess the future.
Right. It sounds simple, but doing that when your portfolio is bleeding red, that's the hard part, isn't it? Tuning out that noise.
Oh, absolutely. It's human nature to feel that fear or greed. Graham's pendulum is a good reminder we have to actively fight that tendency.
And then there's Bogle. He sort of builds on that emotional discipline, but really reframes risk itself for the long haul, right? He argues the volatility we see day to day isn't the real danger.
Precisely. Bogle would say the biggest risk isn't your portfolio value dropping for a bit. The real long-term risk is not being invested at all, letting your money just sit there, not working for you.
Losing out on compounding.
Exactly. He called compounding a miracle, starting early, even small amounts, over decades.
Hmm.
The growth can be staggering. He also talked about market seasons, like fall and winter, times of famine after the feast. But those leaner periods where maybe the market return isn't matching what the underlying companies are doing, that's the moment for the patient, long-term investor.
Okay, so we have Graham's mindset, Bogle's focus on time, and the real risk. But practically speaking, how do you, listening right now, actually apply this? Simplicity seems like a really big theme for both of them.
It really is. Bogle especially hammered on simplicity. Avoid chasing crazy returns with complex, expensive strategies. And that brings up costs. He called it the tyranny of compounding costs. Even tiny fees, trading expenses, taxes, they build up.
How much impact can they really have?
Well, think about it. Let's say costs drag things down by maybe 3% a year overall. It seems small, right? But over decades, on a, say, 10% average annual return, that 3% can eat up almost a third of your total earnings.
Wow, a third. That's huge. So the answer is leaning towards things like low-cost index funds.
That's certainly Bogle's big solution, and the
Yeah.
data backs it up pretty strongly. You mentioned the Vanguard S&P 500 fund.
Yeah, the stats are kind of mind-blowing, outperforming like 94, 97% of active funds after taxes over 15 years.
hmm Low-cost index funds just consistently do better than most active managers over the long run, often with less risk too. And it's not just Bogle. You have legends like Peter Lynch, Charles Schwab. Even they recommended index funds for most people.
So it really comes together then. Those market dips, they aren't just scary, they can be genuine buying opportunities. If you're focused on value, stay disciplined, and crucially, keep those costs down.
That's the core message. Emotion is the enemy. Simplicity, cost control, and time are your best friends.
So here's something for you to think about. Knowing all this, what's the one core principle you're going to stick to next time the market swings? Which idea will help you let those cycles just run their course? Something to mull over for your own investing path.